Trick question. I'm Jewish. We don't do it. Gotcha.
This is episode 21 of Farm to Markets, and today we're talking about changes the Build Back Better plan can make to backdoor and mega backdoor Roth conversions if prudent investing is no longer prudent, and we have another lightning round at the end. Today we are joined by Aaron Elster of Buchalter Law Firm in sunny Los Angeles, California. Aaron was named one to watch by Best Lawyers in 2021 and 2022 for his work in real estate law. Welcome, Aaron.
Thank you. No ties in Los Angeles, apparently.
All right, well, we'll get started with the first question. So the Build Back Better plan is on the cusp of being approved, and if enacted, could have significant ramifications for the backdoor and mega backdoor Roth IRA contribution strategies. Joe, why don't you give us your thoughts on what Congress is trying to do with these new rules?
I think Congress is trying to get some political headway with this particular rule. It's the Peter Thiel rule. And the background on this whole legislation is that Peter Thiel threw a few $1,000s in a Roth IRA back when PayPal was worth virtually nothing, and essentially made Peter Thiel into a billionaire. And because of his good fortune and great timing, the Roth IRA essentially has grown to billions of dollars, resulting in a tax-free opportunity for Peter Thiel. He'll never pay taxes on the money in that particular Roth IRA. The reality is that very, very, very few people do Roth conversions every year. Most of the people who do Roth conversions are making between $100,000 and $500,000 a year. Certainly a handful of our clients take advantage of the backdoor Roth conversion. But if they get rid of this, it's not going to have a huge impact on either tax revenue collection or even in terms of tax avoidance. What will end up happening is there'll just be another opportunity that our industry will come up with for people to avoid paying the taxes some other way. But quite frankly, it's going to have very little impact on our economy one way or the other.
Yeah, I mean, I agree with that sentiment too. I mean, it seems like the proposals tend to be more and more narrowly tailored and just trying to target just the wealthiest, richest Americans. So, you say it's the Peter Thiel rule. I mean, that's pretty much the kind of people that this is targeting. I mean, if I had to guess as to what the actual legislation would look like, I mean, the IRS isn't going to want to do away with these Roth conversions because you're required to pay tax on unrealized gains when you convert. I could see maybe there could be a cap on the value of the Roth. There's been talk of required distributions. But yeah, ultimately, it's just a handful of people that are really going to be impacted. So yeah, I agree. More work for you, Joe.
Well, maybe less work if they're eliminated, right?
Right.
I agree with both of you guys. I think it's kind of a preemptive way of having more Peter Thiels enter the market. I also think it might be a way for government to tap into more revenue in the future. And by sticking it to the rich, that's a platform that helps get some legislation across the goal line. So by eliminating money going into a Roth IRA, which have tax deferred growth and no required minimum distributions, theoretically, there will be more taxable assets floating out there in the ether sometime in the future. I don't think this is going to do anything to close any inequality gaps if that's what they're going for. I think it might actually widen it. I don't think rich people got rich because of Roth conversions. They'll continue to be rich long after Roth conversions are gone. I think what it ultimately does is it hurts the people on the margins right now, and it puts a ceiling on poor people with aspirations to be on the margins someday. The types of people that do these strategies, like my dad said, it's not the uber wealthy, super high income Scrooge McDuck types trying to skirt paying taxes that they owe. It's mostly middle to high middle income earners that are financially responsible people and usually live well below their means. So I'm not a big fan of this, but that's all right, I guess.
So, ultimately the target is they're targeting people that are making, over 400,000, 450,000 for joint married couples. and people with $10,000 or more in their IRAs are particularly in the crosshairs here. And I get the idea. They're sending a strong message to the American public that we're going to make the rich pay their fair share. And also, if you're trying to pass a $1 trillion spending bill, which has actually been significantly reduced from the original bill, you're going to squeeze the rag for every penny you can get out of it, and to pass this bill. And a lot of this legislation isn't going to be enacted for another 10 years, which happens to be the same amount of time that these budgets tend to be scored over a 10-year period. So if you can say, hey, we're going to enact this in 10 years and try and incentivize people to maybe get some of this stuff in before time's up, you can raise a little bit more revenue to try and get this thing passed, or at least give the appearance that you're going to raise some more revenue. Ultimately, though, what I wish they would do is, if they really want to, if they really want to help the people under 400,000, under 450,000, it would be nice if what they do is just raise the contributions to other plans like simple IRAs and IRAs. With those plans, there's virtually, compared to like a 401k plan, a defined benefit plan, there's virtually no regulations and strings attached on with IRAs and simple IRAs. And if Congress really wants to help, the middle class America, they would just raise the contribution limits on these plans. So you have, business owners and doctors that are making $250,000 to $300,000 a year, allow them to put a significant amount of money into these plans that don't have the headaches and the regulations that go along with 401k plans. And I think you would do the middle America a huge favor by doing that, and let them defer an actual something that make a material difference in their tax situation.
Good point.
Well, I would just add quickly. Yeah, I mean, I agree completely. I mean, the maximum contribution, I think, on an IRA or Roth IRA is $6,000 a year. It was $5,500 for a long time. I mean, it's really been stagnant. The conversion, the backdoor Roth conversion, I don't know if, I mean, you have to be in a pretty particular tax situation, I think, to take advantage of it, because you will have to pay a significant tax bill when you convert. And then, have a portfolio with the long-term growth potential that you could enjoy tax-free in the future. So I guess with all things, it depends. Who does this help? Who does it hurt? I mean, I'm not in any position personally to make any conversions. I mean, I don't want to pay a tax bill today. I feel, the conversion, I think, is generally for a wealthier client. And so if you tighten up those rules, I just don't know how much it affects, middle class earners. That's all I'm saying, in my opinion.
That's a great point. I think I actually saw some statistics on it. And I think in 2019, I think only 82,000 Americans making between 50,000 and 100,000 actually executed a Roth conversion out of the 52 million Americans that were actually eligible to do it. So the amount of people that this is actually going to affect, I think some other people pointed out at the beginning of the show, is actually pretty small. And so I think you guys might be onto something, is that it might be just more about the message that they're trying to convey than the actual amount of people that it's going to affect. So that's great.
Well, they call it the Peter Thiel rule, but Peter Thiel didn't even do a backdoor Roth IRA. His income was so low at the time that he qualified for just making the regular. It might have been only $2,000 back in those days when this actually took place. So the real concern, there's a lot of talk about the backdoor Roth IRA, and only special circumstances does it actually work. The real concern are people that are extremely successful in their Roth IRAs. So the average schmo, he throws money into an S&P 500 index fund and gets 12, 13, 14% returns on an annualized basis for a period. Well, they're not worried about that. They're worried about the guy who buys Tesla, for nothing, and then it turns into something, or buys Bitcoin at $32 in a Roth, and now it's worth whatever it is today. So it's almost like it's okay to be successful, but the last thing in the world we want is for people to be too successful, because if they do, we're going to have to come up with legislation with your name on it.
For the sake of this conversation, we're focusing on the elimination of the backdoor Roth and the mega backdoor Roth conversions. But this is just an attachment to other things they're doing too. Like if you make over $10 million or you have over $10 million in a retirement plan, you have to take out, what is it, 50% of all of that?
Yeah.
And then not being able to make contributions, period, if you're over an income threshold. So I think this kind of goes hand in hand with a lot of things they're trying to change.
Right.
All right, we'll go and move on here. All right, with investments like Bitcoin, Ethereum, and stocks like Tesla, Nvidia, GameStop, and AMC hitting astronomical heights, some investors that have followed the tried and true rules of investing, such as diversification and buying assets close to their actual values, have significantly underperformed their peers and are starting to wonder if it's still prudent to be a prudent investor. Joe, what are your thoughts?
Well, back in the 1990s, there was a Wall Street Journal article that I read, which talked about these young entrepreneurs who are multimillionaires, and their dads worked 40 years for these Fortune 500 companies, and the child net worth vastly surpassed the parents going, and it had exactly the same question. Do valuations mean anything? Well, 2 years later, the growth industry was therapists who basically consoled young millionaires who thought they were millionaires. And those individuals were now living in their parents' basement. So what goes around kind of comes around. I'm of the opinion that you don't fight Wall Street. You can't be smarter than Wall Street, or you can't be smarter than the market. That's a better way of putting it. The market's going to do what the market's going to do. I think valuation is certainly a prudent way to invest, but don't fight growth. If growth is happening, it's not a bad idea to use both strategies in your personal accounts. In the same way that you diversify your holdings, you don't put everything in one company, you don't put everything in stocks, don't put everything in the same strategy. Spread those strategies out, because in the business cycle, different strategies are going to have different outcomes. And for most people, particularly our clients who essentially depend on us for distribution decisions, it's a good idea to not have all of your money in one strategy when that strategy is out of favor.
Yeah, just I'd add, I mean, it's, when you look around, you see people that are making a ton of money off of, whether it's crypto or if it's Tesla or if it's Lucid or whatever it is, it's you get envious and you want to jump along. You're looking for the next thing too, but the traditional fundamentals don't really support it in a lot of sense. So I think on one hand, I don't think prudent investing is off the table. I agree that you've got to split up the pie into various pieces. And that, if it's crypto or if it's NFTs or whatever it is that people are making a ton of money, maybe NFT isn't the best example for this, but like a stock like Tesla has been trading very high for a very long time and for a lot of money. So it's tough to say that it's wrong. We read an article in anticipation of this that it's basically saying that Tesla would have to sell enough cars to dominate the market for 10 years in order to justify the stock price. Well, that's under a traditional approach. When I was thinking when they were coming up with advanced statistics for basketball, sabermetrics to apply to basketball players.
Yep.
And they were working them out, and they said, okay, well, whatever we come up with that doesn't say that Shaq is the best player is the wrong metric. We've messed something up. So maybe it's whatever valuation that you come up with that doesn't say that Tesla is the best, most valuable auto stock is the wrong metric. I don't know. Joe's saying you don't argue with the market. I mean, the market's pretty clear that Tesla's the most valuable car company in the world. They're great cars. It's tough to argue with that.
I agree. I think the prudent investment rule is still alive and well. I think that the investment options have changed a little bit, but the principles of investing with prudence should still apply to investors. I'm sure they were asking the same question back in the go-go 90s when everyone was pouring money into tech, or in the early 2000s when people were flipping real estate. And we're asking the same question now with meme stocks and cryptocurrencies and Tesla. I think you should still understand what you're investing in. One of my favorite books in finance is The Richest Man in Babylon. And one of the tenets is invest, but know what you're investing in. We were just having this conversation earlier this morning in your office, Dad, about if you know a lot about commodities, doesn't mean you're going to make it in real estate. And if you know a lot about stocks, doesn't mean you're going to make it in commodities. So as long as you do your due diligence, you understand what you're investing in, I think that's probably prudent enough to cover the base there.
Aaron brought up a great point with sabermetrics in basketball, and I've read a couple of books about sabermetrics specifically in baseball, and the idea is spot on. Is that a lot of times it's hard to quantify certain aspects about players that's going to make them great, and it's even harder to predict. Where the next Babe Ruth, the next Wayne Gretzky, the next LeBron James is going to come from, because statistics can only take you so far. And there's some point where you have to judge, a person's character and what the company's doing, and kind of make some predictions about how you feel the company's going to do. And that's a great point to make. However, where the point that where people get hung up is that they see people who take all of their 401k assets and dump it into Tesla, and then they're millionaires overnight. And those are the kind of stories that are frustrating people, because you're over here, you're holding the S&P 500. By the way, the S&P 500 has had double-digit returns over the last 5 years, so you're not doing bad, but you're also not retired either. And so, the point of this article is that should we just jettison the traditional values of investing and just get into all the stocks that are being hyped by a lot of the media. And the thing is that you're going to hear a lot of success stories, especially when I get on StockTwits and when I get on Reddit, and I talk about with these people around the water cooler. They're always telling you about their successes, but very few people are telling you about their failures. And Drew and I were actually looking at a list of like 20 companies that were just through the roof in 2020. Zoom is one of them, Peloton, and there are a few others on there. But right now, Zoom is down 55% from its high. So if you've gotten into Zoom, after it'd been hyped, after it, what they call popped, after it's been up 300%, you'd have lost, about half your money. Same thing with Teladoc's, down about 60%, and a few others that just crushed the leather off the ball in 2020. And a lot of people jumped in at the end of the year and are now down, 50 to 70%. So yeah, a lot of it is just you absolutely have to follow the rules of investing, and especially if you're investing other people's money. You don't know what's around the corner. It's hard to tell which investments are going to work and which ones aren't, because the metrics don't give you that information. So the diversification, buying stocks that are close to their valuations, you still have to do those things. And if you find once in every 10 years, like an Elon Musk or something like that, take 5% of your portfolio, buy their stock and see where it goes. But you don't want to be pushing everything into these risky stocks and just completely disregarding the rules of investing.
Well, yeah, I mean, you need to be prepared to lose it all.
Right. Exactly.
So, how much of your portfolio are you willing to risk, put it all on the line?
Right.
I think find that number and go for it.
Yeah. When you hear these kids, who take everything in their 401k, put it in Bitcoin and Tesla, and they're retired at the age of 25, they could have just as easily been broke by the time they're age 25, and sent them back, 5 to 10 years worth of having to work.
We've had a pretty good run with this last bull run. And I remember years ago, I knocked on the door of this one particular woman who, very nice, got a cordial conversation, but she decided not to do business with me. And then 5 years later, she calls me on the phone and says, "How much do you charge? I was wondering if I could do business with you." And I said, "Well, why?" And she said, "Well, I've done pretty well in my stocks. I just want you to take a look at my portfolio." And I looked at her portfolio, and she started out with $10,000 and it turned into $500,000 in the course of 5 years. I go, I can't do this well for you. And she said, I bought a stock last week. It was the first time I ever lost money, and I realized I don't know what I'm doing. And this was 1999. I mean, at the top of the market. I mean, she was incredibly astute in terms of her self-awareness, because we actually moved the portfolio into more of a diversified. We certainly kept some of her Intel. We certainly kept some of her Microsoft, but we sold a lot of it, paid the capital gains, which were higher in those days. And we put her in laddered CDs. We bought some bonds. We bought some real estate investment trusts, a little bit in gold, some value stocks, and that sort of thing. And then when 2000, 2001, and 2002 hit, she protected most of the value of her account. When the NASDAQ, and we don't remember this, but the NASDAQ dropped 80% in 3 years. So it was just hovering over 5,000, and it was around 892 or so at the low 3 years later. The NASDAQ's now almost 16,000. So to lose 80% of the value when most of the people got in around 12, 13, 14,000, it could be a bloodbath for people who didn't follow the prudent man rule.
My wife recently asked me to start investing her Mad Money for her, and so I'm gonna. So in my case, for sure, I'm definitely following the rules of diversification, because I don't want to have the conversation that I lost 80% of her Mad Money on AMC when I bought it at its all-time high. So
well, Tom, I punted on my wife's Mad Money, and I had Drew manage that for her.
Yeah. I guess it's better for her to hate her son than her
That's
husband.
right.
Absolutely. All right, well, we'll move on to the lightning round of our show, where we basically try and answer a bunch of questions real fast. So the first one is that headphones are becoming trendy again, as many of America's youth are opting for the wired headphones versus the wireless earbuds. Joe, which one are you?
Oh, absolutely wireless. My days of being fashion conscious are over, and wireless is the way to go.
Aaron?
Wireless. If you got the wire on, you knock the wire into something, never again.
Drew?
I guess I go wireless. I use those bone contusion headphones that actually aren't earbuds at all, but they are connected by Wi-Fi, or Bluetooth rather.
Yeah, I'm not young enough either. I'm going with once I ponied up the money to pay like $100 for the Apple AirPods. I'm never going back. I mean, it's been nice. I don't know why you would go back. But
Well, if you want to look good while you're strutting down the street, evidently that's why you would go back.
yeah,
But
well,
The style now is kind of like mid-90s look for everything. So that includes wired headphones.
Right.
When it comes to playing music, there are a number of different genres. Joe, which genre do you prefer to play?
Well, on my guitar lately, I've been playing Christmas music and folk music. I mean, the old stuff, Kingston Trio, Peter Seeger, that kind of stuff.
Aaron?
I play the piano. I'm not very good, so I just kind of do the same old 70s hits, Elton John and whatnot. Just kind of stay within my range, entertain the party.
I like to do, I don't know if it's a genre of just like finger picking on the guitar. That style.
Yeah.
Like flamenco?
Not flamenco, just like some Travis picking. I don't know who to reference, but more just country folk.
Yeah.
Usually I stick with, Kansas, Dust in the Wind, Blackbird. And the only reason I do those because they're relatively easy to do on the guitar. I'd probably branch into like blues guitar, but it's a little too complicated for me at this point.
A nice trick if you're a guitar player is just use a capo and change the pitch, and it's like you're playing a whole new song.
Yeah.
All right. Around Christmas time, there's been some debate whether some families open presents on Christmas Eve and some families opt to open their presents on Christmas Day. Joe, when does your family open Christmas presents?
Our family opened stocking stuffers on Christmas Eve, and the rest of the Christmas gifts that are under the tree on Christmas morning.
Aaron?
Trick question. I'm Jewish. We don't do it.
Oh.
Gotcha. I was waiting for that. No, but if I did, I'm just an observer. I think Christmas morning seems like the more wholesome time to do it. That's how I would do it.
I'm just a Christmas morning, everything on Christmas morning kind of guy.
Yeah, when I was growing up, we did Christmas Eve, but now we do Christmas morning because I don't know. I feel like
Because you're married?
Well, I just feel like it's undisciplined to wait till Christmas Eve. That's not waiting until Christmas. You're supposed to wait till Christmas morning. So yeah. Anyways. All right, well, that's it for Farm to Markets episode 21. Again, we appreciate you joining us. And Aaron, we appreciate you taking time out of your day, especially at such short notice to join us on our podcast. So again, we really appreciate you having us here. And if you like what we're doing, remember to hit that like button. Other than that, we'll see you next week.